Hey everyone, and welcome to another Isbister Financial Services update. It's been a wee while, so there's a bit to cover off, but I'll try and keep it brief. So I thought I'd break it into a couple of sections. Firstly, what's happening in the mortgages space, and then that'll be followed by a session around what's happening in the investment space. So firstly, in the mortgages, banks are very constrained, and they're being constrained for a number of reasons. Firstly, the Reserve Bank is not keen on a bank failure, so they are requiring all the banks to hold additional amounts of capital, and they are also insisting that banks not borrow as much money as they were previously overseas. So that's constraining in itself, but then you add to that as well that interest rates are at an all-time low or near to an all-time low. So getting funds into the banks from depositors is also an issue. So you're tending to see a bit of a funding war going on amongst the banks. They're scrapping over term deposits in most cases. In some cases, some banks are actually positioned quite well and need to get some money out the door. So what does that mean for banks? Well, really what it means is they are being very picky about what they do. So you imagine if you've got $10,000 to lend to some mates, 15 mates, they all want to borrow $1,000 from you. One of them, you can only charge one of them a higher interest rate, and the rest of them you've got to charge a pretty similar interest rate. So you're going to have no problem getting rid of the money. So what do? You start to look at, well, who's going to give me this money back? And it might be that you'd expect all of your mates to give you your money back, but some are a better bet than others. And so the banks, what they're doing is they're looking at the responsible lending code and going, okay, what can we do to make sure that we are lending out money in a way that we are going to be better positioned to get this money back. So they're looking at your income, how stable that is, your deposit, the property you're buying, all those sorts of things. So you may consider yourself a good risk, but what we're seeing in the market at the moment, even people that have previously been a good risk, are missing out on funding from banks simply because they are cherry picking their clients that virtually have no risk or very little risk anyway. Everything has an element of risk. So I think when you're looking for some funding from the banks, you've got to get in early, because it is quite a process to get through the banks at the moment. And potentially you may not get what you want from the banks, and you may not get anything at all from the banks. So then we have to start looking at second tier finance options for you, which is slightly more expensive. So if you're looking at rental properties or building projects, then you need to factor that into your costs before you start to enter into your proposal or your proposition. So key message there, get in early, get your finances sorted, get everything prepared, and we'll start to source the funds for you, aiming for the cheapest funds as possible, of course. But at the end of the day, if what you want is to get some funds for your project, then you need to look at how much that's going to cost you. So in the investment space, there's been a bit of volatility in the markets, and I think that's mainly been caused by investors being a little bit nervy, because what we're seeing out there is we're still seeing robust growth figures coming in from companies across the states. We're seeing good growth in economies. So a lot of the fundamentals are there for good growth to continue. But, say there is a big but. What we are seeing at the moment is yield curves flattening. So normally yield curves start low and move up with longer term interest rates. But what we're starting to see is interest rates starting to flatten. So what that means is investors, if they're not going to get a higher return for investing long, they're going to keep their money in short-term investments, which isn't great either for people that have got projects that are going to come on down the line. But another key thing about this is when we've seen yield curves flatten in the past, they have traditionally been followed by a recession within 2 years of the yield curve flattening. So what I'm saying is we're possibly going to see good growth for the next wee while, but there is potentially going to be a recession come down the line. Who knows exactly when? No one can predict that. But history tells us that when yield curves have flattened in the past, within the next 2 years, that's been followed by a recession. So it's something to take note of with your investments and also with your portfolios that you have investments in. That's it from me, guys. Any questions or queries, please don't hesitate to get in touch. Hope you guys are having fun out there and look forward to catching up soon. Thank you.